Hi, everyone. Saturday, February 18th. Good to be with all of you again. I know it's a holiday weekend, so maybe some folks have other things to do, but others can be sure to listen to the replay. We've got a great room today. My longtime friend Albert Saporta is with us, one of the most astute observers of markets globally that it's been my pleasure to know. Albert, welcome. Good to see you. Good to hear you. Good to be with you.
Hi, George. How you doing?
Excellent. Before we get moving here, as is our custom, I'd like to just review this date in history. I get a little education out of this. Hopefully, you do as well. So, in chronological order, I didn't actually know this. It's kind of cool. In 1878, Thomas Edison invented the phonograph. Who knew? 1878. In 1930, Pluto was discovered by Clyde Tombaugh. That's in 1924, using a 13-inch telescope at the Lowell Observatory in Flagstaff, Arizona. Clyde had no formal training in astronomy. Interesting. And then lastly, one of the less glorious days of the United States, in 1942, U.S. President Franklin Roosevelt signed an executive order allowing the internment of Japanese Americans during World War II. That was a dark chapter in American history. Any rate, to the matter at hand, Albert, great to see you again. It's been, I looked up, I think it was, 7, 8 months ago that we were last together in one of these spaces. The exact date escapes me. So before we get started, sorry, go ahead, Albert, go ahead.
No, I'm
Yeah,
listening.
no worries. Before we get started, Albert, it might be useful just to kick it off by just explaining the other proprietor of AIM&R research. It's been around for, was it 20 some odd years? Just explain what it is you do, and then we can get into your remarks for today. Albert has a series of charts that he wishes to speak from. This will not be death by PowerPoint, but it'll help inform his discussion. So, Albert, why don't you start off by explaining what it is exactly you do? And from there, you can get into your presentation. In the meantime, I will post your charts to the nest. So take it away, Albert.
Thanks, George. Right. Well, AIM&R was I founded AIM&R in 1995, and between 95 and 2006, I was running a hedge fund group out of Geneva, mainly investing in global arbitrage opportunities, whether it was risk arbitrage or arbitrage of holding company structures and stubs, which is kind of my long time specialty, and doing pair trading. I mean, basically pretty low volatility type trade. And the older I was getting, the more risk I would allow myself to take. And in 2006, I looking at the overvaluation of markets at the time, I actually sold my hedge fund group, and I retired for a number of years. I was living in Brazil, and then I was watching the financial crisis unfold from the beaches of Rio, and then I came back to the markets in 2011, 12, and at that time, rather than start up a new hedge fund, I restarted a research firm. So that's what I'm doing right now, and we're talking to about 30 of some of the largest hedge funds, advising them on the strategies that I've been covering for years, and including now, because I'm grown up, more macro stuff, more directional stuff. And so our clients are mainly in the U.S., some in the U.K., some large funds in the U.K., in Brazil, and in Hong Kong. So that's what we do. So we talk to these hedge funds, some pension funds, a number of high net worth family offices, and that's it. We're based in Geneva, and I look at everything that moves. I guess that's certainly something that I have in common with George. Um, and yeah, so that's in a nutshell what we're doing.
Terrific. So, Albert, I posted the slides to the nest that you provided to me. I think there's 7 or 8. And again, this won't be death by PowerPoint, but why don't you just, have a go at it for, I don't know, 10, 20 minutes.
Yeah.
Maybe highlight the key points, your beliefs about markets and where you see risks and opportunities.
Right. Okay. So, I mean, the first thing is, without going into being or whatever, one of the main things that drive equity markets in certainly since March between
Say, Albert, your connection is getting a little bit sketchy. I don't know what's going on
right.
here. You were fine until about a minute ago, and then it started getting a little
Okay.
weird.
What about now?
Go ahead. I'll tell you if it doesn't work. Keep going.
Right. Okay, so the relationship between equities and bonds have been driving markets, and that's not unusual, in an inflationary world and in a world where the Fed is aggressively raising rates, and so the equity markets have been moving in steps with the bond market, and one of the most consistent indicator, which has been really working like a Swiss clock, has been the way the Nasdaq has been moving with the 30-year bond, and obviously, I mean, this is no, I mean, it shouldn't be any mystery in the sense that what's driving valuation and valuation expansion and contraction is the relationship between these discounted cash flow that you would see typically in tech stocks and interest rates, and obviously the lower the interest rates, the more valuable would be companies, even if they have zero earnings. But as soon as interest rates starts to go up, then the relationship between equities and bonds, and especially tech equities and bonds, becomes very critical. So on the first chart, you can see the chart between QQQ and TLT. So these are the two ETFs for the Nasdaq and the 30-year treasuries, and the green line at the bottom of that chart represents the relative performance of the Nasdaq versus the 30-year. So each time the Nasdaq has been overshooting bonds, the 30-year, this was pretty much a good time to go short the Nasdaq, and if you wanted to do it on a hedge basis, it was a pretty good time to go short the Nasdaq and go long the 30-year, and this has been an incredibly consistent trade, basically for the last 1 year plus. And so what's happened in the last few months is that toward the end of last year, the Nasdaq came back into sync with bonds, which kind of explains why we had a rally at the beginning of the year. The thing is that in this rally, the Nasdaq has been overshooting again. The Nasdaq has been overshooting again the bond market, and so we are back to the same level of overvaluation in terms of stocks relative to bonds. If we go on the next chart, the second chart, it kind of shows the same. It shows the same thing, but zooming up on the last 4 months, and even in these last 4 months, you can see these arrows which are pointing up and down. Basically, when the Nasdaq was going up and bonds were going down, you could be sure that they would converge. So they converge in September. They converge again, toward the end of last year. Then, throughout January and the beginning of February, they sort of moved step in step, and then since mid-February, the bond market has been going down in prices, yields up, and the Nasdaq has kept going up, and that is what creating what I think is the current opportunity in terms of of being short again. Of course, the way this could not work if you are outright short is if the bond market starts to go up again. But if we look at what's been happening in the last year plus, every time we've had that kind of dislocation, the dislocation has been worked out by the Nasdaq meeting the bond market on the downside. Okay, so that's point number one. Point number two is shown on the third chart, which looks at the VIX versus the high yield spread. And again, these are two, and you've got a few years there, 5 years, but actually you can look at it over 10 years and 20 years, and it's kind of the same thing. Basically, the VIX zooms up when credit spreads are blowing up, and vice versa. And so what we see in that chart is that we do have a dislocation where the VIX has been coming down very significantly in the last 2-3 months, whereas the credit spreads, I mean, they did come down a bit as well, but they still remain quite elevated, compared to recent history. And obviously, if economic conditions get worse, that these credit spreads have the potential of zooming up again. So, what I'm saying here is that, I mean, first of all, there's a disconnection between what the equity market participants and what the bond market actually, it's the same disconnection as the one I've just talked about before. There is a disconnection between what the bond market people think and what the equity market people thinks. And I can't remember who said that, but somebody said the bond market is always right. And so I would suggest that the potential for the VIX to go up significantly from the current level is pretty high. And so that ties in with the charts before. And so I kind of believe we are at minima. We are on the verge of of a let's say toward a retest of the lows, at the very least, on the equity market.
Albert, on this last point, I'm no expert in volatility. Some people are saying the VIX has kind of lost its significance for all kinds of reasons, and I don't know what to make of that. Do you have any observations about whether the VIX
Look,
still has?
I don't know whether it's it's lost significance. I mean, there are lots of people that are buying options for hedging and for this and for that. But I mean, what's for sure is that when markets are falling and falling fast, the VIX goes up, and when markets are getting, are going up in a sustained manner, the VIX is going down, and so it remains. I mean, two things. It remains, first of all, an indicator as to whether people are complacent or not, and they are right now. Whether they are in a panic mode, which is definitely not not the case right now. So I think it's whatever goes in the background of the way the VIX is being measured, it remains I think that very useful indicator, which you can trade as well, by the way, because there are futures on the VIX. So
Okay.
all right, so and the charts do show, I mean, this connection between between the credit spreads and the VIX, and obviously when you do get into periods of stress, like the spike that you see on the chart is COVID, but you could look at all periods of stress, and you would see the same thing where credit spreads and the VIX go hand in hand, and each time you do have dislocation, they actually come back together. So and again, most of the time it is the credit spread which tends to be right, and so the VIX meets credit spread rather than the other way around.
Makes sense. Okay, let's move on to the next slide.
Okay, so to make it to make it short, what I've just said is that I've shown basically two fairly to understand indicators that are showing that that equities are out of steps with bonds, and when that's been the case, at least in the recent past, meaning the last 12 14 months, that's been a time to be short. Okay, and now to bring the sort of long-term perspective as to in terms of valuations and so on. It's not like markets are cheap in any shape or form after the after the last year's correction. So markets are actually still extremely expensive. So if we look at the next chart, the next chart is looking at long-term valuations since I think 1947. They come from John Hussman, who puts up great very long-term charts on a whole bunch of things. But I mean, this one is self-explanatory. It shows market cap versus gross value added, which is basically one step below the price to sales ratio in a way. And so what that chart is showing is that, okay, there's been some kind of evaluation adjustment in the last in the last 12 months, but we're still extremely expensive by historical by historical measures. I mean, the market is basically on that measure, but actually if you look at price to sales ratio and price to book ratios, these kind of ratios, um, you will see that the market is as expensive as it was at the top of 2007, and almost as expensive as it was at the top of 2001, and significantly more expensive than any other period before. So we're still looking at a market which is massively overvalued, despite the fact that there was some kind of a valuation adjustment last year. The next chart, and now I'll show the sort of main problems for the market. The next chart is showing that EPS and margins have overshot. We're looking at on these charts at operating margins. These are the green and the green and red lines, and then the green line is showing the sort of average long-term profit margin, which is 8.5%. So we can see that there's been a very significant overshoot in the last basically in the last 2 years in terms of operating margins, in terms of profit margins, and this is what I call the magic COVID recovery. There was this COVID crisis where economies went into an instant recession and then instant recovery, and companies made a fortune out of that. They were able to not only maintain the margin, I mean, they were not only able to regain their margins to keep them, but actually profit margins just went through the roof during this period of time. The thing is, if we go to the next chart, and actually I mean, even on that chart it's kind of obvious, but if we go to the next chart, the next chart is showing the earnings per share for the S&P and GDP. I mean, the nominal GDP for the U.S. Economy, and basically EPS are sort of going along with nominal GDP, and that that kind of makes sense, right? I mean, why would EPS over the very long term grow at a faster rate than than the GDP, which actually represents the globality of the U.S. economy? What you can observe is that actually there was a long period of sort of undershooting during the 70s and early 80s, which were basically the inflationary times. So in other words, EPS was were not keeping track with nominal GDP. And then since the mid 80s, and then even more so, basically EPS started to grow much faster than nominal GDP. But you can see that every so often there would be periods of when GDP would come back to sorry where when EPS would come back to nominal GDP. So the overshoot would be working themselves over time, except basically since this COVID crisis, where you can see on the chart this huge gap between EPS and nominal GDP. And the next chart is showing the same thing, but basically since the 80s, which is like the beginning of the bull market. EPS have been tracking, very, very closely nominal GDP during this period of time. They did overshoot in 2000, and this was worked out. They overshot even more so, before the financial crisis, but this was worked out as well, in 2009 and 2010, and then you see, this very abnormal situation where, basically the way EPS have expanded relative to nominal GDP is unprecedented, and so. Obviously, I mean, these things. Why not? Get these things? Continue forever. But that's not the way it's been working. And I don't see any reason why, there should be a disconnection long term between EPS and nominal GDP. So my expectation, without being an analyst, whether macro or micro, but my expectation is that EPS are going to get crushed. um, we're not talking about EPS going down 5%, or I think the consensus estimate is EPS going down something like, I don't know, between 2 and 4% in 2023, and then and then the consensus for 2024 is again plus 9%, and again 9% in 2025. So basically, the analysts are expecting this this overshoot to continue, and it's never happened. um, I think we're looking at a huge downturn in EPS. If we go to the next chart, we see again, the white line is EPS, the orange line is operating margins, and obviously what makes EPS go down is a fall in the operating margin, which has already started. The peak in operating margin was in February last year, and that was 16%. The operating margins now around 14.5%. Again, analysts are projecting these margins to remain relatively stable from here, and then to expand again, into next year. I think this is, again, for the same reason, extremely unlikely. And usually, if we look at what's been happening in the last decades, is that the usual back to the mean in terms of margins is going back to low double digit or high single digit margins, sort of around 8 to 12% margin. So we were at 16. We are now at 14 and a half. I mean, if margins were going down to 12 or 10, that would have a very, very significant impact on EPS.
Yeah, Albert, isn't this a key battleground here? Because you know, earnings have there's a big bid-ask spread between the bears and the bulls on earnings. As you just pointed out, earnings are down. Earnings growth has slipped a few percent, and but people are expecting it to resume in 24, 25, as opposed to some of the more influential thinkers in the street think, just to take the S&P as a proxy, that you're looking at a much bigger decline. S&P earnings maybe 180, 190, 200, something like that. I mean, we had Michael Harnett in the room a couple weeks ago, and he made the case, and he's not alone. And so there seems to be, this is really where the battle's being fought. I mean, the the bears think that there's going to be recession and a big earnings decline. That's what history would argue. The bulls are saying otherwise, but it sounds like you're coming out in the bears camp, if I understand you correctly.
You understood me very correctly. Yeah.
Got it.
That's for sure. So the I mean the EPS for the S&P right now is around 220, 223, I think. Okay, and again, if we look at the next chart, which looks at EPS, both trailing and forward, so we're around 220. Consensus estimate again is sort of pretty flat to slightly down in 223, and then back up 10% in 224. If we go back to if we go back toward trend, I'm not even talking going back to trend. If we go back toward trend, you can make a case that the EPS is not going to be like 225 or 230. It's going to be more like 185. Okay, I think that would be a fairly conservative EPS forecast in a gloomy, given let's say given my gloomy view. Okay, and if you ascribe sort of mid-range bear market bottom valuation, like 12 times, and again 12 times is pretty pretty bullish for a sort of low cycle of let's say a secular low cycle in terms of valuation. I mean, I think secular low cycle valuations are more like 8 times earnings, but let's assume 12 times 185 dollars EPS, that yields an S&P of 2220. Okay, so this is I think where we could very easily go in until we get to the end of this bear market phase. Okay. The next
You
sorry.
could. That's just a huge. I mean, again, this is where the battlegrounds are being fought. I mean, it's if earnings, well, even if earnings 185. I mean, with the market at where are we, 4100 or whatever. I mean, you're talking what 22 times earnings or something like that. I mean, that's just I don't know. It seems a bit of a disconnect, but so far the market's not going where you are. Frankly, I've been surprised how well earnings have held up and how well the market's held up. But it takes two to make a market.
Sure.
So
Yeah.
fair enough. All right, let's go on. Let's finish up here on the slide so we can get a
Okay,
discussion.
so the next slide, I mean, everybody knows, the yield curve is inverted, and that's and then people tell you, like this is the most I would say the most well-known sort of recession, like everybody's expecting a recession, and some of the argument is, if everybody knows there's a recession because the yield curve is inverted, that's already discounted in the price. I mean, so first of all, actually, people were having the same discussion. I remember very clearly in 2007, when the yield curve was inverted, and no one, I mean, people were poo-pooing the possibility of a recession. What I'm saying, is that obviously, things always look the best and the greatest and the most exciting, just before the recession sets in, and that's by definition. So certainly what the economic condition that you see today, have nothing to do with what they should become, given where the yield curve is setting right now. And so I think we have two pretty strong indicator that the coming recession is a foregone conclusion. One is the yield curve, and I would not dismiss it, because it's always worked. And it's very easy to understand why it's always working. Is that basically the yield curve gets inverted because the Fed is raising rates, at a much faster clip than the bond market, at the long end, and the long end doesn't go up as much as the short end, because eventually the bond market expects that there will be a recession because of the rise in interest rates. And so what's been happening, and what's basically almost been happening, is that the Fed is raising rates until we get into a recession. So that's why this yield curve inversion, and then when it becomes when it goes from inversion to positively sloped, that's always been a precursor to. I mean, the inversion has always been a precursor to the recession, and the recession, comes in when the yield curves flattens and gets positive again. It's always been like that. So um, again, this time could be different, but until proven, wrong, I would stick with my view that basically the yield curve inversion and the EPS, way out of sync with nominal GDP, this huge dislocation, both of these things are pointing out, to a recession. Why it's gonna come, I have no idea. I mean, I have an idea. I mean, interest rates have gone up from 0 to to 5, and that's an enormous economic shock. And in fact, this is the biggest rise in interest rates, and there's never been such a big tightening without some sort of an economic shock. So I would argue that the people that think that this is not going to happen, I think these people are sort of asleep at the wheel, really. All right, so the last chart is actually, I mean, to counter some of the bullish arguments. The main bullish argument is that the Fed is almost down with the tightening. So the market is starting to anticipate the Fed pivot, and that the Fed um, um, will stop raising rates and will go in reverse. The thing is, on this chart, you see that in all the after all the sort of major tightening periods, um, the market actually went up into the tightening and actually started to crash once the tightening was over and once the Fed was actually starting to to cut interest rates. I think this is maybe the most interesting, could be the most interesting chart. And so what you usually get in bull market phase, is that actually, as the Fed raises interest rates because you have inflationary pressure, and because the economy is overheating, and because the economy is overheating, you got great economic conditions, unemployment is low, and so on, and people speculate. Okay, they don't see further than that. Everything looks good. They buy stocks and so on. The Fed raises rates. Um, People say, don't fight the Fed, but actually the equity market fights the Fed all the time. And so it gets to the point where there is a very significant dislocation between equities and bonds, and then the market crashes, uh, and it crashes because the recession comes, and the recession comes because the Fed has been raising rates until the recession is coming. And so that's why the market tends to peak at the time when the Fed is done with raising rates and starts to cut rates. So the story of this Fed pivot and being bullish because the Fed is going to cut rates. Again, this is certainly not what's been happening in the last 50 years actually. And so I will leave it here,
That's
in terms of the comments, and I'm open for your questions.
that's terrific, Albert. And I urge everyone, get some questions going here. Anyone who's got a question or comment for Albert, please weigh in. The more the merrier. You've given us a lot to chew on here, Albert. I love your charts. I apologize if there are too many, but they're very helpful in highlighting the points, hammering the points home that you're trying to make. So I guess if I just distill or break down what you said, I mean you've got interest rates have gone up considerably. Equities have gone the other way. So it's a disconnect. Just trying to summarize what you've said here. You've got a disconnect between the rise in interest rates and the fact that equities have rallied. So equities are expensive relative to bonds. At the same time, you think profit margins are very elevated and going to go down. So, whatever multiple you've got elevated multiples on elevated earnings, and unambiguously that leads to much lower market. Is that more or less what you're saying? I
Yeah,
think. Yeah. Yeah.
absolutely. Yeah.
Terrific. So, try arguing against yourself. Let's say you're wrong. What? Because markets have a way of confounding everyone. It certainly confounded me the last couple of months, that's for sure. I haven't covered myself in glory. But like, do you question whether you're right, or did you just question what the time frame in which it may take to play out? I mean, you've got history on your side, it would seem, but what gives you pause, or when you try to argue with yourself, when you have some self doubt? What is it really a question of timing from your standpoint?
I mean, I mean, it can always be the timing, but actually, if you look at this, again, this chart, Nasdaq versus TLT, and actually it could be the S&P or the Russell. I mean, it's been such a great indicator that I actually think I think from this point on, the it's going to be very, very difficult for equity markets to go up if the bond market doesn't go up, if yields don't go up. So what can be wrong? What could go wrong? You could get a massive rally in the bond market because I don't know, the inflation all of a sudden is much lower, or the recession is actually coming, and people anticipate more aggressive cutting by the Fed. But I've just shown that usually when that happens, you do get the recession, and then markets go down anyway. So I think to come back to the big picture, George, and we've talked about that before. I think we are in a very big asset liquidation phase, which started in it didn't start last year. It actually started in February 2021. When people started to sell all the shitty stocks, all the super speculative stocks, and so on. And then it started to hit the very large cap stocks and so on. And we are in this phase where we're having and during these periods of time you have up and downs, and we just had an up period, and I think we'll resume fairly soon a period of markets going down. And then whether the market falls off like 30%, like I think it will, or whether it's just 5% and we go down to the lows of of the end of the year, and then we rally again. Everything is a moving target. It depends on a lot of things, but I think we are still in this we're still in this asset liquidation phase, and frankly the sentiment, it's still party time. People are still not disgusted by by holding stocks, so I kind of think that there's still a lot of downside ahead. I mean, right now people are switching. They've switched from tech to retail, or to cyclical or financials and so on. But in an asset liquidation phase, everything goes down.
Right. Okay, so let's get the questions going here. I've got plenty more questions, but I'd like to recognize our friend Abe. Abe, good to see you. You have a question for Albert? Go for it.
I do. Thanks, George, for hosting. As always, great spaces. Albert, what's your view on the consumer balance sheets, including corporate balance sheets? There's definitely a bull narrative out there that can't be ignored. No one should ignore any view that consumer balance sheets or retail balance sheets are actually quite good, and as a consequence, even if we do get higher rates for longer, that will delay the potentiality of a recession, should it come into perhaps next year. And that may also change the dynamics of where the Fed is at, because they clearly will now have a lot more time with more data in order to assess their own monetary policy moving forward. And we may end up with a rosier picture than perhaps anticipated. Thank you.
Okay, I don't know the numbers. I haven't seen the charts. In terms of consumer balance sheet leverage and so on. But correct me if I'm wrong. But a large part of the of these balance sheets, and the way consumer are looking wealthy, if you will, is because one, of equity values, and two, of real estate values. So if you take these two things, if you mark these two things, if you mark them down to market, and let's say again, that's another thing I haven't talked about, but how can real estate remains elevated in a world where you've gone from mortgages at 1% and then they are at 6.5 or something like that. So the valuation mark to market of people's houses and maybe portfolio could be a lot lower than what the numbers suggest. And so I'm not sure that the consumer is that much healthier than at previous peaks before, asset peaks.
Say, on that point, Abe, I wanted to ask you,
Yeah.
and Albert, you wouldn't know, Abe is in Toronto, over the epicenter of one of the biggest real estate bubbles in the world. And Abe, you always have interesting insights about Canadian real estate. Can you just update us on what's going on in your part of the world with respect to real estate?
Yeah. So what we're seeing is, without material volumes, you have no possibility for price discovery. So this notion that we've seen a bottom perhaps is rather nonsensical, because we don't have enough volume to really determine that. So we're sitting in a situation right now where we have no volume. From peak to trough on a national average, we're down 13%. Some some cities outside of the epicenters, like Toronto, Vancouver, are down as high as 35%. Um, the the mortgage market here, very, very different than what you guys have south of the border. We have 5-year mortgages. There's no such thing as a 30-year. So we've got a lot more exposure on the short end of the curve, and that's starting to wreak some havoc. So about 36% of our total mortgages are variable. So they're all, they're all dealing with mortgages that are north of 6%. And these were guys that a year ago were probably in the low twos. And we also have runoff on the fixed side, which means that at any given point in time, you're likely going to have a variable camp north of 50%, which is a huge problem, because on a historical basis, you're looking at a cohort that was used to, zero interest rate policy, where rates were anemic, very, very low. The only thing saving this market, from my lens, and I've been in this market since, I think, 1986, I can tell you, is we have no volume, zero volume, and the rental market is incredibly tight, amidst a government that is driving immigration policy literally through the roof. So there's nowhere to go, and there's no substitution. So when you have zero substitution, people don't move, and cost of moving is now also cost prohibitive. So we're kind of stuck. So what's happening is really simple. You have the underbelly of the real estate market that is reeling because they can't afford 6.5% rates of interest, especially those that bought last 5 years and highly levered. Got also inflationary pressures that's also ripping. And so what's happening, because they can't move, they're forced to stay. But pretty soon, at the rate that things are going, if this stays in a prolonged state, there's going to be a lot of Canadians eating craft dinner, because you may have excess savings. And that is true, by the way. The problem here is that you can't write off your mortgage, your interest the interest component against any income. So there's other dynamics here, and the market is highly, highly levered. So really, what you're seeing is an underbelly that is starting to feel the pain. And the hope here, and I'll just stop. The hope is that somehow there's going to be a magical pivot, and that's going to bring the party back all over again. And we can flip condos like hamburgers and cheeseburgers here, because that's basically what's been going on. But that's beginning to fade as well, as more and more Canadians wake up to the reality that we're not a reserve currency, and the only central bank that matters is the Federal Reserve, which is essentially the Eccles building. That's all that really matters.
Thanks.
So
Thanks
that's
for
it.
that, Abe.
Yeah.
I'd love for you to come on later, not right now, but hang around, please, because I want to draw on your expertise, what you're seeing going on in the commodity markets and in Europe. So just stay there. Let's work some others into the conversation. Bobby, good to see you. Please unmute yourself. Do you have a question for Billy? Bobby, the floor is yours.
Yeah, thanks. Al, just a quick question. So, in terms of disinflation, do you believe that they're going to be able to avoid deflation? Or you think we're just going to see this disinflation just bottom out just in time before we go into deflation? And then the second question is your base case EPS of 185 at 12 times, or was that just the multiple you were given conservatively to this room? Thanks.
Right. So on disinflation or deflation, I don't think we are in this kind of environment at all. So I'd be very, very, very surprised, if we ever get to the 2% target that the Fed has, and the reasons are sort of pretty easy to pinpoint. One is, they're all kind of very macro stuff, but you have this war in Ukraine, and it is it is a kind of world war. Basically Europe and the US are fighting the Russians, using the Ukrainians as proxy. But this is causing basically all of the European and US and Australia and Japan and Korea and so on, to increase very, very significantly their defense budgets. And we haven't seen the end of that at all. For example, Germany, which had almost zero defense budget, is increasing that by multiples of 10 times or 20 times. So there is, and that's very inflationary. And war times are inflationary periods. Then you have global warming, which is also going to cause government to spend zillions of dollars. And that's again inflationary, and the replacement of fossil fuels and the change the way we produce things. All these things. Basically global warming. Again, these are investments which are going to be inflationary as well. Then we have deglobalization, which obviously when you manufacture everything in China and you change that from China to even Turkey or Mexico or back home in the US or in Europe, that's extremely inflationary as well. Then you have demographics, which are not favorable in most economies, pretty much everywhere, and that's again very inflationary. So just looking at these four big factors, I don't see how we're going to get to much lower inflation. I think if we hit 4% or 5%, I think that's going to be lucky. And again, going from an environment of sort of 0 to 1% or 2% max, for decades, and then all of a sudden you're in an environment where inflation is more like going to be, let's call it 3 to 6. That's a very major adjustment that investors are going to have to make. So I'm definitely not in the deflation or disinflation camp. I'm in the inflation camp, and actually things could get inflation could set up much higher than that. I haven't even talked about disruptions, supply chains and all these kind of things. Although to a certain extent the reopening of China is going at least for in the short term, that may make things a little bit better. But deglobalization, no matter whether China is open or not, that's something which is a fact. On my target, 12 times 185. This is usually I don't look at that, but this is a way how you can rationalize the S&P going down 30-40%.
Can I ask a quick follow-up question?
By all
Sure.
means, go ahead. Yep.
Thanks. And then I'm just gonna step down. I'll step down after that, George. Thanks again for the space. And thank you for your answer, Al. Great answer, great points, and I do agree with all of them. But I think just on a temporary basis, wouldn't you say just a conservative 185 12 times? We're at what, 25, 22 times now? Isn't that just disinflationary in itself, just on a temporary basis? Especially if you're perceiving that this is going to happen going forward. And that's it. Thanks, Al and George.
Okay, I'm not sure I understood what you meant in terms of the multiple and disinflation. But if you so yeah, I'm not sure I
Yeah,
understood
I think Bobby, when it gets to sequencing, I mean, yeah, I mean, if the market were to fall a lot, yeah, that'd be disinflationary for sure. But absent a crisis or a crash, I think Albert's not expecting that.
look.
Albert,
Yeah, I mean, everything is very circular. All these arguments go around and around. But the one way you get to inflation back to 2%, if is it could happen, but that would probably mean a massive recession.
right? No, 100%, 100%. So, and we'll get to Neely. Hey, good to see you, Neely. Just hang on one second. So, Albert, one other question related to that: if a lot of conspiracy theorists, if the Fed, everything's all Fed all the time, but if we're only going to, I'd like to flesh out a little bit more of your thoughts along where inflation goes to. If in fact, you know, the Fed knows there is thinking they're never going to get to 2%, they're really just they'll be lucky to get to 3 or 4, and they're engaging in open math operations. They're sort of talking the talk, but the reality is that they know they're not going to get there. And as a matter of fact, I was reading something interesting the other day, was making the argument 3 to 4% inflation is actually good because it's more nominal economic activity, which means more tax revenue, which is good for the budget deficit and so on and so forth. In other words, you want to inflate away the debt. So, how would you view? Do you think that's plausible? And how would your view change if, in fact, they took the flag down and said, you know what, forget about 2%, we'll settle for 3 or 4?
Okay, I mean, I think that's what's going to happen. I think they and the thing about inflating away the debt is. I mean, there are two ways to pay debt: is through war and through inflation. So, but how would the market react? I don't know.
Well,
My immediate reaction is that 22 times earnings in a 4% environment doesn't really work. And then one should ask also, there's something that needs to happen as well, by the way, is a normalization of the bond market. And normalization of the bond market means real rates of return. So if we do settle, let's say, at 4% inflation, what should be the yield on the 10-year? I think over time, the yield on the 10 years has got to yield positive returns. That's another adjustment that's got to take place, which means also asset liquidation, in terms of bond market, which is probably not over. But 4% inflation, I think the 10-year could easily yield 5, 6, you know, 100 basis, to 200 basis real yield, which is, kind of the historical average before the financial crisis. So again, 5-6% 10-year yield, you're never going to get 22 times earnings.
I mean, you're already making the case that the market already is not taken on board fully where the bonds are. Now we're going to up the ante and say, instead of a 10-year at 380, wherever it is, you're saying, oh my God, what happens if it goes to 5 or 6 or whatever? So,
Mm-hmm.
so yeah, no, the increase in the risk-free rate impacts all asset prices. It makes complete sense. One other question before we go to Neely. What would that do if not maybe focusing less on the overall market, but how would that impact sort of by sector or types of stocks you want to own, maybe long duration, short duration, et cetera, et cetera. Could you imagine in that type of world, not all stocks would would respond equally? That maybe, I don't know, long duration stocks would go down more. Like, what would you, if we go to that world, how would you expect the sector rotation or factor rotation to shift in that type of scenario?
Right. So we know that in an inflationary world, hard assets, are faring better. So all the commodity-based type stocks are, should be doing well. That being said, I'm not particularly keen on the oil sector, if only because I think they've they were extremely low, and if you look at the performance of the ETFs, for example XLE versus or XOP versus the oil futures, oil prices. Very very significant part of the long term underperformance has been worked out. So I don't see any major dislocation in the oil stock, except to say that oil stocks are way cheaper than the than the S&P, but I'm not sure this is necessarily the driving factor in terms of relative performance. I think what's more critical is whether the oil stocks are overshooting or undershooting the oil price, and they're not overshooting over the long term. They overshoot, actually, oil stocks are overshooting the oil price over the short term, but over the long term they've actually worked out a lot of their underperformance. And so one could be bullish on oil. It doesn't mean that it doesn't translate into being bullish in oil stocks right now, I think. The same is true actually of copper. If anything, I prefer the commodity, the metal, rather than the stocks. The only area where you do have a dislocation between the underlying commodity and stocks is in the precious metals, gold mines and gold and silver mines, and these they're very very difficult to to analyze, and it's very difficult to pick the right time to buy them. But when you're looking at hard assets, the only area where where you see undervaluation and at the same time the equity, the stocks undershooting the underlying commodity, that's in the gold space.
That's great. Sorry, go
Yeah.
ahead. Go ahead.
No, I was going to say, I'm in terms of sectors, on the so on the long side, I'm at a loss in terms of buying things outright. I just don't think this is the time to be long anything except maybe gold, but gold mines. But I don't think it's the time to be long anything. And on the short side, there are plenty of opportunities, of course.
And just to remind everyone, this is not investment advice. Do your own work. But no, that appreciate that, Billy. All right, let's pivot here just a little bit. Not talking about a Fed pivot, but we have one of the smartest cookies out there on the consumer stocks. Neely, always good to see you and hear from you. How have you been? And share some of your wisdom with us of what you see going on in the world.
George, it is so good to be back with you again. I think last time you and I talked, I did give you a heads up, and you're the people who listen to your spaces, that this is going to be a wild 2023 to read consumption behavior. And boy, did retail sales already get us off to a solid start on that. Like, why we care about consumption is because in the United States, and I'm myopically and uniquely focused on just the US economy and the US consumer, it's, take it or leave it. And we drive 2/3 of the economy. It's huge, right, for what we do. But month by month, if I had a calendar, I should make a calendar of like how every single month is going to bring like a wild ride. And right now it's all about tax. And this is why I would love to just chat through a little bit more of what we're seeing on the tax side. At a high level, we have, tax season, which lasts about 15 weeks in total of when we get to observe data. And it's been my professional experience and observation that, more than rates or prices or stock market even or employment, what really rules consumption behavior during those 15 weeks is perceptions around how well someone does at tax refund season. And we're 2 weeks in of the data reads. We're 18% of, ish of the filings that will be filed. And we're already seeing almost a 50% increase in the number of refunds being issued so far. And we think that that's going to probably give some false signals about where the consumer is going to end up landing this year. But it's, more hands in people's pockets, George. It'll give some real wacky near-term signals in our view. So I just wanted to get up here. I put a tweet up in the nest. Would love to field any questions you have about it, but it's going to be a wild ride this year.
So Neely, you were very prescient in highlighting this. And maybe a few months ago when we had that back, wasn't it 2 or 3 months ago? Maybe you could just go a little bit deeper as to why these refunds are running so much higher.
You bet. So the average refund amount, just so that I'm level setting, the average refund amount is actually down 14%. But what we think is influencing that is we have a ton more refunds, as you can see, like 50%, higher issued refunds that are probably people who owed a little last year and now they have a little more this year. So it's like, that's going to lower the average refund amount, but there's just more people experiencing refunds. And the reason why we believe that's happening in large part is because of the way that taxes have been withheld. We could observe all throughout last year that tax withholdings were on a tear through the Treasury data. And it just didn't totally add up as to why that was, either in the number of people employed or factoring in some sort of wage growth. A lot of people don't focus on the data that we look at kind of on a daily and a weekly basis, which is fine. And so we did some digging and we uncovered an interesting math calculation that there's an old form W-4 and there's a new form W-4 floating out there. And it's impossible to know who and how many are on the new versus the old with any data that's available to us. But we believe that because we fired 24 million people during COVID, rehired them, and then you had all this quiet quitting, churning of reemployment, people fill out this new W-4 form right when they get hired, and they tend to not revisit it. And so we just think that there was more being withheld just mathematically through this new form, and that created the situation that we're now seeing, that more people are just getting refunded. So that it's kind of a one-year phenomenon, we think, but it's kind of fascinating to watch it play out.
So just to repeat, Neely, you said the average actual refund is down 14%, but this is really like a mix shift.
Yeah,
is that what
it's impossible to know exactly, but the presupposition is that it's mix shift because, if you're issuing 50% more refunds, it just means that's the volume of refunds are probably dictating that average refund amount, not necessarily, you just have a lot of people who are probably.
Yeah. That's staggering just to point out, because I only looked at the detail of your tweet in the nest right now. I urge everyone to look at it. Total returns up 9, but total refunds up 48. That's you ever seen anything like that before?
No, which is why this is this one-year phenomenon. Sometimes, George, because you've done this forever too. Sometimes you put a lot of blood, sweat, and tears into something that you only see once, right, in the market, right. And that's what this is right now.
Wow, that's really. Wow.
But here's where it's going to get tricky is it looks really good. And we're coming off of a really strong January retail sales, right? Well, why are retail sales so strong in January? A lot of possible influences occurring there. But one of them is that the cost of living increases increased by almost 9% among the Social Security benefit payout people. And, old people, retired people, they like to go out to dinner. And I can put a tweet in the nest. I don't know if someone's needs to mute there. But with that cost of living increase, we saw restaurants up like 24% year over year in January, like a massive acceleration. It was warm weather. A bunch of retirees had extra, payments basically in their pockets. We think that possibly gift card redemptions, the fact that it costs way more, actually, we saw this in CPI, to make food at home than it is just to go down the street and grab like dinner. It's narrowing between food at home and food away at home. And it's like that premium is all around like, washing your dishes or not washing your dishes. So, restaurants was a significant contributor to why retail sales had accelerated. It's like 14% of the overall retail sales. So that was really strong. And then I think February could end up looking strong because of what we're seeing out of these tax refunds. But here's the kicker. When you get to March 1, you're going to have like millions of people who are going to lose some incremental SNAP benefits. This is like food stamps. So the lower income, like the floor is going to fall out underneath them, right? And like maybe some of their tax refunds can kind of carry them for a little bit longer, but March retail sales could actually look massively disappointing off of the January and the February trend because of what's going on with SNAP benefits. Fast forward to April and May, we got 17 million people have basically been getting free healthcare through the CARES Act related to the Medicaid component. That's going away because the pandemic emergency is going away. So then like they're going to have to either try to go find a job, pay privately for healthcare. They won't do that. It's way too expensive. I know, I have to pay it. And then you get to June, and that's when we're going to hear from the Supreme Court, and they're going to tell us whether or not, forgiveness on student loans is going to happen. TLDR, it's not going to happen. And all of a sudden, payment processors are going to start sending out notices for repayment on student loans. So it's going to be this very schizophrenic start, to consumption capacity to spend. But it matters to know how to navigate this. And all of these things aren't like massive conjecture. These are factual things that are out in the public domain.
Wow. One last thing I'll ask you, Natalie, before we go to Jay. Gasoline prices, they've moderated significantly over the last few months. Aren't gas prices usually a big swing factor too in terms of consumers' purchasing power and their propensity to spend?
Certainly for the people who are in the kind of sub 75,000 average annual household income versus those who are above. Just for context, if you were to look at consumption as by category, by income demographic, which we do in our private practice, for boards and CEOs, it would represent 4, 5, 6% if you're in that lower income consumer. But if you're in a higher income consumer demographic, it might represent sub 2% of your consumption, right? So it doesn't land evenly for everyone, but for the lower income consumer, that it definitely is a bigger factor for them.
Got it. Makes a ton of sense. Okay, let's go to Jay, and then after Jay, we'll go to Dave Nikoski. Jay, welcome.
Hi, how are you? I was just going to ask Neely, what did that look like in 2001?
What?
As far as the tax refunds and the increase in refunds, you had 50%. Go ahead.
I could go back and look at our data set. I'm not in front of my computer, but we do actually track all of that.
Okay, what does it comp out to, like closest in the past?
Let me answer it back this way. It'll be wholly unsatisfactory for you, but let me answer it to you this way.
Okay.
The last time we saw a massive change, right, to the W-4 form was actually in 1986. And in fact, it's made congressional record. You can actually see the members of Congress debating what happened and what a mess and cause of confusion it created. It was that significant of an effect to how we did it. So the W-4 form, we think, is a cause of confusion. And that caused, let's fast forward this, right? That caused an overwithholding dynamic as well, right? Back in 86. I'm not going to draw lines to 87, but, just for what it's worth. And, but here's, at a very high level, here's what it does, especially as it relates to debt ceiling conversation. That means our deficit is actually greater than what we think it is right now, right? If we've got to return, incrementally $50 billion more than what we normally return in refund, which is our current estimate, that means we're that much more on thin margins on our deficit.
Okay. Thank you very much.
My pleasure.
Thanks, Neely. Before we go to Dave, one question for you, Neely. As relates to the housing slowdown, um, some people point to a blip of a bounce recently. So a couple of questions. What are you seeing in spending in the housing related area? A lot of conjecture about, DIY, Home Depot, these sorts of things may experience a slowdown. Do you have any perspective on housing related stuff, Neely?
I really don't. I just follow a couple of really smart people about it all. And I would say, I think I'm loosely in that camp of, there's a lot of spending power we've created by, locking in a lot of loans in the United States at 3%, right, or lower. So I don't know. I do think that in general, people care about their nest, and we do think that babies are coming too. I know it's a very contrarian view for another conversation. And in general, I think people are going to be making investments in their nest. Yeah,
Thanks
you
for
got
that.
it.
Okay, so let's go to a good mutual friend, another person from Minnesota. You guys come in a bunch, don't you? Dave Nikoski. For those of you who don't know Dave, he's a good friend of the room, one of the most astute technicians out there. So, Dave, welcome. What's on your mind, Dave?
Hey, George. Great to be back. Good to hear from you and Neely, who's another good friend of mine as well. Neely and I have known each other for many years, just like you, George. So thank you for having me in the room. Just saw you on and thought I'd pop in. I'm seeing some deterioration in much of the technology arena. I posted out on my timeline, a couple days ago and discussed it in rooms over the last week that when I see parabolic relative strength downtrends in the safety areas of the market and they're not joining in whatsoever in the rally, I know there's, every couple of months we get this sector rotation that, drives everyone out and then brings everyone back in. You are getting relative strength stabilization in utilities, staples, and healthcare in the XLV. When I'm pulling up charts of, the two poster childs for momentum are Tesla and NVIDIA. And, if you look at an RSI chart, it does suggest that they're running out of upward momentum. It doesn't mean they have to break down, but, I'm getting, and we put it in our work with clients, over the last few weeks that we saw 4165 as kind of a hurdle rate for the S&P. And I'm not bearish the markets. I'm not bullish like I've been saying. It's not a stock market. It's a market of stocks. We've been very, constructive on the consumer, and so it was good to see the consumer numbers come out, retail sales. And I've been discussing that, ever since June. The internals of the market are much healthier than people would like to, see. But at the same time, it's a very quirky market. It's not something that we've seen before. If you looked at the RCD versus the XLY or XRT, the average retail stock has been doing extremely well. And I continue to say focus on individual names, groups within sectors. We did downgrade energy last week. We flipped a couple of times on it, and it didn't gain alpha, it didn't lose alpha, but relative strength is deteriorating in it. I was a big proponent of the service stocks back in October with the OIH breaking the downtrend versus XOP. I'm keeping a close eye on it. The other area that I think could have problems with the inflections that we're seeing in bonds, I guess I was surprised to see that the long bonds or duration actually, from the onset on Friday, started out, with yields moving up, and by the end of the day, it was just the short end that was responding. If we do shoot higher on the long side, I'd be more concerned about, high price ticket items, financing rates, whether it's from cars to homes. And that would be a greater concern to me technically. Three things that I've discussed over the last 6 months. I want to see small caps outperform large caps, and we've been seeing that to a degree. We just don't have a breakdown or significant alpha. Small caps were actually up on the week last week. IWC, which is the micro caps, I want to see them hold in there. They're not breaking down. They're closer to the 6-month highs than 6-month lows. And, look at yield spreads. I put a chart up on my timeline. I think it was Friday morning. We're getting close to, having that pop out. It's not popping out yet. But it's something I'm going to keep a close eye on. We're basis points away from that inflection. So, I hope to say I'll catch it the day of. I don't think anyone can prognosticate. And the third thing that I've discussed is, what banks are doing. And, the KRE, I pointed out, a couple months ago that it was right near a major support level, bounced off of it, developed what looked like a bullish flag and popped to the top side of that pattern. So, it's every day is you have to go through the charts just about every day on the things that you're most concerned about or have worrisome thoughts about. But again, I'm seeing more of a defensive posture building here at this level, with that reversal and relative strength in the defensive areas that have just absolutely been pummeled on a relative basis. So, I think the best we can hope for is mark some time here if we're going to stay in a bullish trajectory. My thoughts are, and I think Cantro is by far the best I've heard on the street. And again, no one, Cantro doesn't try to time the market. He just gives you the big picture. And I do think that housing, will still end up being a problem. I can't point to the time period it is, but, if I'm looking at the XHB, I'm seeing momentum deterioration from that. I pointed out, plenty of times over the last 6 months, you're hitting relative strength highs. It's not something I'm pounding the table on, but, as a technician, I have to look at it and say, yep, I acknowledge it's hitting, new price and relative strength highs. You far outperform the market if you bought them in April of last year than where you are today. But, so keep a close eye on that. And again, not investment advice, but, trying to give you a big picture of what's happening in the market.
Appreciate that a lot. If you could just hang right there, Dave. Billy, you
Yes.
still there? Albert, you there?
Yeah, I'm here. Yeah.
Yeah. So I'm just curious. You've heard a bunch of stuff from Neely on the consumer, and then some of Dave Nikoski's technical prognostications. You had mentioned earlier your views on various sectors. I'm wondering if you have any reaction to any of this, or if you want, or maybe looking further afield, looking outside the U.S., putting any of this in context. Any thoughts on sectors or looking at countries? Anything you'd like to expound upon, Albert?
Yeah. First of all, on housing, something very interesting, which is that the lumber prices have totally collapsed, and the sector XHB has been doing very well, and that's a major disconnect here. I kind of think that housing stocks and XHB look like great short, but on the short side, I'm not so much focusing on tech because it did go down a lot, and I've been looking at some of the stocks which have been rebounding a lot in the tech space, and I've sort of identified NVIDIA, Advanced Micro Device, the semiconductor ETF, Microsoft. There was an IPO for Mobileye. Intel made an IPO for that, and I mean the stock has been doing extremely well. But this is a large cap semiconductor stock which is on 19 times revenues or something like that. So these are Apple is a short, and I don't know whether you want to put Tesla in the tech or the auto sector, but the stock has gone up basically 100%. From the trough at the beginning of the year until the peak a few days ago, and that's massively overvalued. In terms of other sectors, I'm shorting some of the big retailers like Costco. I'm also shorting the retail ETF and the consumer discretionary ETFs. And other stocks which come as being massively overvalued are, retailers like Burlington, Ross Stores, TGX. I mean, these are, very popular stocks, obviously, but they're massively overvalued. Burlington actually collapsed last year, and it had a very significant rally, and I think that's a great short. I'm shorting Nike as well. Then there are some industrial stocks like Caterpillar, which are trading at crazy valuations in terms of EV sales, but even in terms of price earnings ratio and EV EBITDA. I mean, these are things which are selling at decades high in terms of valuations. The same goes for XLI, which is the industrial ETF. And then I'm shorting financials. Schwab, Blackstone, Morgan Stanley, Mastercard, MSCI, BlackRock. Goldman. All these stocks. These are stocks which typically, no matter the valuations, actually get decimated in a bear market. So the sort of high beta stocks on the downside. So that's what I'm shorting. That's what I'm shorting in the U.S.
So you see this again. You're just elaborating on what you said earlier. You don't have much you want to buy, but you've got a lot of things you don't like on the short side.
Yeah.
So
then and then looking abroad, my view is for better or worse, my view is tainted by this conflict in the Ukraine. I basically continue to think that Europe is completely screwed by this situation, and I don't see any way that this situation is going to get better. Frankly, I don't know who would want to invest. I don't know who would want to invest in Poland, Czech Republic, Romania, all these countries that are bordering Poland, that are bordering Ukraine, and by extension, I don't see why you would want to invest in in Europe. So actually, you look at the the euro stocks in local currency, in euro, it's pretty much at the all-time high, and I think that's I'm certainly not buying that. And by the way, on valuation grounds, buying non-US stock is pretty much the consensus view. And on that, I will differ on that. No matter the valuation, I just think that the geopolitical risks are just so incredibly high. That I think one's got to think beyond price earnings ratio or relative performance, and the same goes to Asia. I want to be as far away from China as possible. I think the reopening of China is just some kind of a short-term event, which obviously, and actually the markets have the Chinese market and Chinese tech has gone through the roof between November and January. So I think that's probably already played. And same thing. I mean, China's got the power of wrecking economies in the region. So actually, I kind of think that I'm bullish on the dollar, and I'm bullish, and I guess I'm not. I was going to say I'm bullish on the U.S. I'm not bullish on the U.S. at all. But long term. I kind of think that the U.S. is the only the only place to be in a way, and markets tend to discount things way in advance, and one could rationalize why European markets or non-U.S. markets have been so cheap relative to the U.S. We got the answer now. Is that the the geopolitical risks are are so big outside of the U.S. That as a matter of fact, the valuations outside of the U.S. had to be much lower than the U.S. So it's a little bit philosophical, but as far as I'm concerned, and keep in mind I'm in Europe. I'm in Geneva, actually, which is a small paradise within Europe. But I kind of to me I kind of disregard completely Europe and Asia. So I'm mainly, I would say, interested in the U.S., although not right now, and then Latin America, which actually is a great beneficiary of inflation, and the stock markets, whether it's in Brazil or not Mexico, but Brazil, Colombia, which are the two main markets in Latin America, and Chile are historically incredibly cheap. So that's where that's the only place where I would consider to be long. Actually, it's Latin America as an inflation hedge.
Hey, Billy, we're going to go to Haystack in a minute, but before that, one question for you on the European situation. As the saying goes, opinions are like noses. Everyone has one. Actually, there's a cruder version of that. But you're just 2 cents into the for what it's worth category because you are in Geneva, closer to the source of the problem than we are. What's your own perspective on the Ukrainian situation, and do you think we're in for a protracted, long drawn out affair? What's your view about the whole Ukrainian situation?
Well, I mean, the view is that my view is that if unfortunately, I guess it cannot get too good for the Ukrainian, because I think if it does get too good for the Ukrainians, the Russians are going to get even more crazy. So, and that's why I think and that may be one of the reasons why the U.S. and European allies are not giving everything on time, and everything that Ukraine needs, because they may not want Ukraine to to sort of beat up the Russians too much. They just give enough so that they that they stay in the conflict. They inflict as many casualties as they can, and to the Russians. So the thing is, I don't see how that thing resolves itself, except some a coup in Russia. And obviously that would be a game changer. But this is not happening. I mean, you cannot count on that. So the point is, the better it gets for Ukraine, the worse it is, because the more crazy Russia. Russia. It is true that Russia cannot lose this thing. I mean, they won't let it happen. So, if you notice, every time there is some kind of good news on the Ukrainian front, like Ukraine, is going to receive tanks, or Ukraine is going to receive that, or Ukraine, has taken this city, or so on. The next day, Ukraine is carpet bombed, by Russia, like crazy. So, imagine that they make great progress somewhere. The Russians haven't finished yet being crazy. I mean, they haven't used chemical weapons yet. They haven't and obviously they haven't used nukes yet. But everything is on the table, I think, to get worse.
So you think we're just looking at a standoff here? There's no exit ramp in sight.
Well, there's no, there's no. I mean, obviously, when you negotiate, you put your maximum demand on the table, and basically Ukraine says, they want everything back, and Russia says they're not giving anything back. But then the thing is, by the Russian constitution, Russia is cannot give back territory that's that it has. I mean, that it considers is territory. So all these territories that have been annexed, it's going to be incredibly difficult, if not impossible, for Russia to give back in a negotiation. So I really don't see any end. And certainly I don't see any positive end to that conflict. At least, in the short term, and I don't even know what the short term is. But and by the way, and if Russia wins this thing, I think this is absolutely catastrophic. So this is the thing. If Russia wins, it's catastrophic. If Ukraine, cannot win too much, otherwise, I don't know, there will be a nuke attack or something, something really really nasty. So I think when you look at markets, to come back to the markets, it kind of looks like at the beginning, in February last year, like exactly a year ago, when Russia started invaded Ukraine, or just before. You are at a point, I think, in Ukraine. Everybody's expecting either Russia to start a huge offensive, or Ukraine to start its own offensive. And so I think the conflict is going to come back to right now, like it's in the background, It's been going on for a year. It's not the main news, in the news every day. But I think it's in the next few weeks it's going to come back to the forefront one way or another, either because Russia is making significant advances, or because Ukraine is making a big counteroffensive, and from there, as I said, Russia could get nastier and nastier. So we've got markets which are kind of elevated, and I think we've got this conflict which can continue to to bring significant risk to the investment scene.
Thanks, Billy. Okay, let's go now to Haystack. Haystack, please unmute yourself. If you have a question for Billy or for Albert or a comment, the floor is yours.
Yeah. Thanks, George. I appreciate it. I've been listening to you for a while and really appreciate it. I wanted to touch on housing myself a bit, and I was glad that Dave and Billy both touched on it briefly. I've been looking at like the home builders and housing in general over the last few months, and it's just been a mystery, the price action, right? Yes, rates did come down a bit, which to an extent makes sense, but it's like it's been so annoyingly persistent, and I've been looking at it as a great short idea, and it seems to be rolling over here a bit. So I just like anytime something seems really obvious, right? Like, shorting XHB or shorting the builders now, especially like a Lennar that has a lot of exposure in like the West Coast and, like Austin and Texas, Southeast, where there's been a huge amount of inventory. They're dumping a ton of inventory still into those areas. So, I'm looking at that area as one of the more interesting risk reward sort of short ideas, not like from a short term put perspective, more like, you know, out to September, maybe even January, but at some point something has to give. So I just kind of wanted to present that and see if anyone has sort of an interesting kind of I don't know, challenge to that, right? That like this might make sense and that these guys can actually continue to run. So that was one point, and I was going to see if anyone has any perspective on that. And the other thing I was going to say is I really like insurance here. Very defensive, especially auto insurance. Progressive is making new all-time highs. They're going to have a great year. Um, they have massive investment book, and with rates going up, their investment income is really surging. So, I really like the name, and I like the space. So I wanted to see if anyone has any views on that as well.
Albert, you have a comment, or Dave, any thoughts on the charts on the builders?
On the builders, I don't have any granular view beyond what I've said before. On Progressive insurance, actually, this is a stock. I mean, it's a momentum stock which has gone from it's gone up like 7 times in the last 7-8 years. I find the stock to be massively overvalued, actually.
Yeah, there's a real chance that they're going to make about $8 in EPS this year, which I mean, I get your point, but if you look at their historical valuation, they've been able to demand a 22, 23 type of valuation in the market. So I don't know. I do see the momentum point, but I also see that they've companies like that have outperformed during like downturns, historically speaking. So
yeah, well, it's again, it's a market, so certainly it's one of the most popular stock in the sector. I actually like one of the least popular stock in the sector, which is a company called Mercury General. It is an auto insurer, and it's in California, which has been a tough place to compete because of local regulation. But the interesting thing about the stock is, one, the share price is very low and valuations are very low. But the most interesting thing is the chairman of that company, the founder, is a guy called George Joseph, and he's 101 years old. He's the largest shareholder, and I think he's going to die one of these days. And when that happens, I think the company will be in play, and the stock is trading around book value when most of the other stocks are trading at 2 and 3 times that. So this is another idea in the sector that you just mentioned, which it's a kind of a special situation, but I think it's interesting.
I'm gonna check it out. I appreciate that. And I was more interested in perspectives on the housing side. Dave, I think you were gonna say something in terms of like the technical picture and what your thoughts are there. So.
Yeah, I mean, they're starting to show signs of running out of upward momentum. I know I saw the permit numbers and realized rates were going down up until about 2 weeks ago. Permit numbers had a little bump up, but if this is anything like previous housing cycles, and we do get the long bonds to move up, there's less than but I estimated permits lower than what came in lower than what was expected, and we were getting up past 3 weeks. So again, I bullish elections on there. One thing I didn't about earlier was the dollar too. I think we can have a bear market rally in the dollar. And I think that, we started out strong on Friday and we gave most of it back. So, technicals are about holding those levels. And, I don't see the dollar holding those levels. And, I need a couple more days before the charts are going to be, predictive of what the next move is going to be on the dollar. But I feel like housing is probably set to fall. I saw an article the other day, San Francisco house prices are down 35%. I know, we can pick out different parts of the country and all argue until we're red in the face and we're not going to get anywhere. But, I think that's probably to be expected. The areas, the most expensive areas of the country are going to have bigger price corrections, especially with where they started at 2 years ago. So, but I think the trend there is down in terms of what house prices are going to do. And so I think that's something you got to, sit back and time will tell. I think it's surprising to everyone that, home builders are hitting 52-week price and relative strength highs. And we can all see rates have gone up considerably. At some point that's going to impact the economy. And I think layoffs as well are just, they're going to go one direction. We can continue to have a job market, a strong job market, but it's probably going to be in the lower paying areas where they can't find help. And therein lies the problem, is you're going to displace high paid workers to move into lower paying jobs is my expectation.
Thanks for that, Dave. Much appreciated. Thanks for the question, Haystack. All right.
Appreciate it.
Yeah, no, that's excellent. So we've been going at this for an hour and 40 minutes. I think it's a good day's work. It's after all holiday weekend, so people should get a life, go on, do something else. So I want to thank Albert. This has been great. I hope.
Thank you.
Yeah, no, this has been terrific. There'll be a replay of this, of course, available on Twitter and the usual places, YouTube, Spotify, etc. Dave, always great to hear from you. I sent you a DM, so let's have a convo later. Anyway, I want to thank everyone for participating. This is wonderful. Enjoy this holiday weekend, and we'll have a space again later this week. Take care,
Thank
everyone.
you, George.
Goodbye.
Appreciate
Take care.
it. Bye-bye.
Bye-bye. Have a good
Goodbye.
day.
Thanks.
Bye. 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 Bye.